Welcome once again to Agriculture Today. Well, the wheat market is on a roll, and that's how we'll open up our grain market segment for this week now, as we're in touch with Dan O'Brien, grain market economist, K-State Research and Extension. He is stationed in his office, Colby, Northwest Kansas, as we visit right here. Great lot of momentum behind wheat prices right now, Dan, and we keep coming back to short supplies worldwide. Is that still the catalyst at work here?
Yes, that and the quality. I understand there are great concerns about the quality of the Australian wheat crop. They have quantity, but with excessive rains that have come, it hasn't helped them in terms of exportable food wheat. We have a good amount of feed wheat around, and I think the residual carryover impact of all the dryness that happened up in Canada, North America, northern states in the U.S. for hard red spring, but also white wheat, which is an increasing proportion of what we export, and frankly, that's what a good amount of what Australia deals with too, as it's sure affected the markets here. We notice, of course, in Kansas, the close of 828, as I understand it. 828 for Dees hard red winter wheat yesterday. On the same day, the close for hard red spring wheat on the Minneapolis exchange was at about 1046, so about over $2 higher. So dry conditions up to the north. You do wonder if in the calculating and figuring of farmers for next spring, if spring wheat prices being as they are, if you'll pull more spring wheat acres in at the expense of maybe soybeans, as there's just a lot of anticipation as we stand right now of the South American crop getting in pretty good shape, with some challenges a lot of challenges in terms of getting nitrogen fertilizer, other types, and phosphorus for the feed grains, that will see acres be forced to shift over into soybeans, and that world supplies, and in all these countries will tend to follow that, given the fertilizer shortages, and so a lot of kind of hidden pessimism, I guess, in terms of where soybeans are going, and you can see it in some of the most basic of technical analysis tools that we watch. You look at the soybean relative strength index, looking at continuous soybean futures. We're at about 40 on a scale of 100. If you're at 50, you're sideways. You're pretty much neutral. While we're at 40 for soybeans. Conversely, if you look at what the relative strength index is for continuous Chicago wheat futures, it's at 66. So completely on the opposite side of optimism versus pessimism for the wheat markets. And again, we're not dyed-in-the-wool chartists here, but the trend for wheat doesn't seem to be abating at all. It had jumped up to about 750 at the end of July, had come down some, with harvests and what other factors affecting the market. But here since basically October 1, you've got a market that although it's had some ups and downs, still closed yesterday 828. Was at 775, but just a few days ago. So strong market. I would add in also for corn, that same relative strength index for the continuous corn futures contracts about 53, so just a little bit positive. So clearly, as you pointed out, the strength in all this right now is in the wheat market. Corn moderate to slightly positive, and soybeans really suffering in terms of the strength and momentum in the market.
Before we speak further about corn and beans, with the wheat market so solid, to say the least right now, producers may be contemplating, if they haven't priced a certain amount of expected 2022 production already, thinking in those terms. Dan, it's always that question, when to pull the trigger, but there are opportunities being expressed in the market, it seems.
In Kansas, as you know, we try to follow Eric, some key elevator locations. A lot of them tend to be terminals in major parts of the state. So we're getting the very top of the prices or trying to follow those. And whereas Kansas wheat spot prices right now, just interesting at Salina, Topeka, Hutchinson, top bids, all 822 on the dot, all 822. Then in Colby, 798 is the top. Garden City, 808. Columbus down southeast, 777. So really all strong, but interesting how in those export terminal oriented locations of Salina, Topeka, and Hutchinson that they're in lockstep, on the top bids. But the new crop bids, which is what you're asking about, for next July, basically, Colby 774, Salina 775, Topeka 794, Garden City 774 again, 780 in Hutchinson, 774 in Columbus. So just tremendous prices historically. If our frame of reference is where we've been the last several years, these are unheard of. Well, they're not unheard of, but they only come in the most challenging of supply demand times. And so that's where we're at. And was talking today with some people that I counsel with on the markets, and yes, these forward pricing opportunities are out there. We've tended in Kansas to be pretty hesitant to be forward pricing, particularly of wheat, just because of all the time that we're going through. We do have that 708 hard red winter wheat crop insurance price to work with, and if anything, people have probably bought up their APHs up to, if they were at 70, maybe they're 75, or if they're 75, maybe they're going to 80 or 85. It costs more money to do that, but you're buying revenue coverage on the bottom end. That and even discussions of supplementing that with SCO insurance, all manner of things being looked at to try to come in underneath these high prices and gain some protection. So you asked the question of the hour: are people forward pricing wheat right now? And I think they like the prices. They don't want to miss. They'd like, on the one hand, not miss out on something going higher, but I would say on the other side, our reticence to take on the yield risk inherent in delivery on forward contracts is a real issue. I think just because of all this time we've got to get to June and all that can happen with wheat, if we do start to move into that area, whereas we get really aggressive at 40 and 50% maybe of our expected production for corn or grain sorghum or even soybeans, we're just our natural reticence and the experience of Kansas weather and extremes affecting the wheat crop, do 10, 15%. Still, I think very possible that these here today, if we were to go on June 15th of next year, 2022, and look back, are we going to have $7.75 to $8 prices that we could have had, 50-50 deal? We might not. And if we didn't, we'll wonder why we didn't. Well, it's because we were afraid we were fearful, we were hesitant to take on the yield risk that those contracts would put upon us.
Couple of points here on corn and beans, respectively. The corn market, as you've excuse me, as you've suggested, seeking direction in a certain respect, but you note that corn basis in Kansas is in fact improving at the moment.
Well, the actual cash prices, driven by where futures are at, again, D's corn closing at 569.5 yesterday, and cash prices, particularly, again, comparing to what I had for records 2 weeks ago, we've seen pretty strong positive improvement, and in most of these basis levels. Spot cash corn running 587 in Northwest, 584 tops in Salina, in Topeka 571, 604 in Garden City, 604 in Hutchinson, 550 in Columbus, all the way through. Other than that Columbus bid, those are all positive cash basis bids. So pretty strong cash markets. The futures. So we showed the futures as just slightly positive for their RSI for corn, but the cash bids and at the local level with a lot of users seeking to get hold of what they can, no doubt is doing pretty well. It's interesting. Forward contract bids, really the highest forward contract bid for 2022 fall is 10 over at Garden City at 556. Everything else is running about 25 to 40 under across the state. So still, those are great prices. And I know my colleague and I, Greg Eibendal, have been looking at cost of production numbers, and we're trying to keep up to have those represent what's been happening in particularly fertilizer market, but also the herbicide market and probably other inputs too. And we're, by our numbers, as last time I looked at them about a week ago, there was still profitability there at these forward contract prices. A lot of risk, that far out, and we won't pull the planters out till April or May or March, but these forward contract bids for next fall are uniformly over $5 and some at $5.50. And if anything scares people, it's the inflation in the costs. And you hear some K-State economists are saying 450 break even or 460, and these are profitable, but they're wondering if there's an end in sight in natural gas and cost inflation leading to fertilizers moving higher, and just a lot of uncertainty where all this works itself out at. Still, right now, if we don't take the most overcautious view, there's profitability in forward contract bids right now heading out in the fall of 2022.
And a parting thought on soybeans, if we might, Dan. The toehold in the Chinese market that the U.S. has benefited from continues to ebb away, it seems. And part of that has to do with something you brought up earlier, the forthcoming South American crop that seems to be going in good shape right now.
Yes. There are reports that China still has need of these crops from the U.S. and from elsewhere. Reports of some sales just happened the last day or so, or within the last weeks, but they've been reticent to come charging into these markets at this time. And being the shrewd buyers they are, they no doubt have a strategy. And I don't begrudge them being good buyers. They do what they can, and as any of us have to do, on depending on which side of the market we're at. But as you bring that about, soybeans, no one's surprised, since about June 1st have been on a pretty strong downtrend, almost a 45-degree line from a high of 1475 to 1221 now, on yet 1221 and a half on yesterday's close for January soybeans. So just thought provoking. One thing I should mention here for soybeans, we've came into the November contract where we are in the, we're beyond the delivery period, but yet here for Kansas City hard red winter wheat and for corn, which would affect grain sorghum, we're coming into a situation where, pardon me, where, contract delivery period is almost upon us. And I think next week, Eric, as we talk, let's look a little bit closer to that to see how people are positioning themselves on that, and as they try to get out of those contracts, are they going to sell high price contracts for decent by March for those two? If so, then there could be just some technical moves in the market that'll have to take place as people right their positions to get themselves out of risk of delivery. That could be happening in the last week or so of November here. So we should try to be on top of that to help people out if we can.
We will pick up on that next week. In the meantime, producers, go to agmanager.info, not only for Dan's notes this week on the grain markets, but for those 2022 crop budgets he and K-State's Greg Eibendal have been working on. They're now being posted at agmanager.info for your use. Until next Friday, Dan, many thanks.
Thanks, Eric. Take care.
He's along with us each week is K-State Research and Extension grain market economist Dan O'Brien here on Agriculture Today.